Welcome to the Finance Podcast. The topic of this episode, Trump's tariff jungle, risk, dominance and new rules for investors, by Susanne Bau, Daniel Lüchinger and Thomas Romming, moderated by Andreas Rotacher.
Welcome to this panel on Trump's tariff jungle, risk, dominance and new rules for investors. My name is Andreas Rotacher, I'm the head of investment research at Complementa and I will be moderating this session. I'm joined today by Daniel Lüchinger, CIO from GKB, Thomas Romming, CIO and head of multi-asset from Senegon, and Susan Bau, portfolio manager for US equities with JP Morgan. Let's start this panel with the general macro backdrop. How do you see the general backdrop, especially in the US, and what are the implications for portfolios and for investors? Who wants to go first?
Do you want me to start?
Yes.
Good afternoon, everybody. Super happy to be here in beautiful Zurich. I'm from New York City, and currently New York City is still buried under the snow. So glad I'm able to be here, and thank you for joining us today. So I'll start with my view on U.S. market, and then I'll pass down to my other panelists to talk about other regions. So just from a macro perspective, I'm still pretty constructive on the U.S. Market. I would say there are three key tailwinds, so-called trifecta. The first one is I believe there's a physical stimulus, and it's largely driven by OBBB, or One Big Beautiful Bill. It's a little bit silly name, but it's pretty impactful because One Big Beautiful Bill can provide corporations tax credit and bonus depreciation. So that's the first tailwind. The second tailwind in US is monetary stimulus. The Fed has been cutting interest rate over the past couple of years, 175 basis points. We expect maybe potentially another one or two interest rate cuts. The third thing I would say is deregulation, and especially we are in the financial industry, and especially for banking system, deregulation. More pragmatic regulator is really favorable to the growth of U.S. economy. On top of that, as you know, U.S. economy is consumption-based. U.S. consumers continue to be pretty resilient, and this OBBB, One Big Beautiful Bill, also provide stimulus to U.S. consumers. U.S. consumers will get over $100 billion worth of tax refunds from no tax on tips, no tax on overtime. So I've been managing money for almost 3 decades now. One thing I've learned is never underestimate the U.S. shoppers' willingness to spend money. So they're going to be spending money this year, so that will provide support on economic growth. And from earnings perspective, our bottom-up research analysts, I work with 20 senior research analysts, they expect earnings to grow between 14-15%. That's still pretty, very, very healthy. And next year we expect 13%. More than happy to talk about tariffs, but I'm going to just maybe give other.
We're going to cover that later.
Yes. So I'll give you our other panelists a chance to.
Yeah. Okay. Maybe Thomas, do you want to add something to the US or maybe Europe, emerging markets? How do you see the global backdrop?
So also welcome from my side. Thank you to be here on this panel. I would say I have a more global view. So let's take Mr. Trump as the front runner. Especially in Europe, you see that he is kicking some governments rightly in their ass. Sorry for that expression. But he's, I think, getting the governments thinking a bit more towards deregulation, more economy, lesser bureaucracy. So I think that's the first point. The second point is we have governments loaded with debt. So the easiest solution is to get inflation and lower interest rates. So also the US is working in that way. All governments, except the Swiss government, they don't have to do that stuff. They just buy global equities. So we will have the focus on several governments to keep up the economy, to keep up the mood for consumers, and so they are dedicated to keep up the whole economy, and that should turn out in nominal rising prices on the stock markets. And you have to look on the bond market that you are paid for the risk you take. So that's more or less the global picture. A lot of governments are sitting in the same boat from my side. Everybody wants maybe a weaker currency. Everybody wants the economy to grow, and especially where I come from Germany, you see how hard it is for a government really to refocus. And so I think I'm not a big fan of Mr. Trump, but I always look what politics are really doing in several segments. I think he's doing a good job as a front runner for a lot of European leaders.
Does that really go together? On the one hand, I have more debt, at the same time I do the deregulation, or I mean the state is predominant.
I think the deregulation is the free lunch. So you don't have to pay for it. You save paper. So even for ESG reasons, it's good. And you get the economy going. So I think we will see similar processes also in Europe, where we have a lot of bureaucracy. I think in Switzerland you just adopted a little bit more to the EU. I think that's the major key to get a relief without taking much more debt. So for me, it's the free lunch, but it's always the question if you just take it. Yeah.
Daniel, do you want to add something to the macro backdrop?
Yeah, I think we share a lot of things. So the view is quite the same. We have the fiscal stimulus, we have the monetary policy stimulus might be coming in the USA as well, and not so in Switzerland. We are already at zero. But there's another thing, that the productivity coming from AI, and I think that's a tailwind also for Trump. And I agree, maybe not on everything what he does, and think he's not doing that a good job that he could do. And he has maybe this artificial intelligence, the productivity rises from there, overshadow the missteps he's doing with tariffs and also other things from a globally perspective, not speaking for deregulation within the US. But I think it's quite a good outlook that we also share, and we are very positive also on Europe, if Europe does as you explained, Thomas.
So like the Draghi agenda to implement some of those points.
Right.
Yeah. Good. Now we talked about the backdrop, but the second part of the question was also, what does it mean for portfolios, right? So the outlook sounds quite positive. How does it look when it comes to positioning, or what should investors do?
Yeah, with this outlook, is maybe from a Swiss perspective very clear that you don't have to hold too much bonds, since there is some term premium you get, but the yield is very low. So with that said, you can invest more in Swiss equities. We like Swiss equities very much because they did not do well the last years. We have the three big companies getting their turnaround. We see pharma and medical services as a good sector, and also their diversification away from the big tech from USA. And as a Swiss investor, the pain for us is the Swiss franc, or we think that Trump wants the dollar to be weak, and that means that the Swiss francs has only one direction, but maybe not in the fast moving like last year, but direction is clear. And so we have to think about how we will hedge this risk, if we will hedge it or if we take the currency risk. Because last year in Swiss francs the US market did not exceptionally well. That's hurting our performance. And that's something Thomas knows since last year and we know since the last 25 years.
Maybe, Thomas, you can add also the Euro perspective, what you're doing with your clients, and then I think we can wrap up this question with what you're doing in your portfolio.
Sure.
No, we are very happy that the dominance of the US stock market was a little bit distributed also to other countries. So in our multi-asset products, we are normally focused on diversification. So the years 23, 24 and the first half of 25, you just had to have Max 7, Nasdaq or S&P 500. So for us as a multi-asset manager who wants to diversify globally, it was a hard job. But due to our very flexible strategy, we were able to, get on the path with this broadening of the performance. We also had the same view on the US dollar, so we manage our portfolios out of a euro view, or in our Swiss franc hedge classes then from a Swiss franc view. So we are back to more normal times, that not only the US equity market, especially the top 10 or top 15 names there, dominate the complete world. So we were positioned in the first step, and we repositioned even more away from the Max 7. We held our positions in the US. We went more to the value side, to small caps, and we were able to pick some niches on the bond side. So I think that's the story which plays out quite clearly since autumn last year. So, and the big question for you is, will we get this redominance of the US stock market starting now or yesterday? Or will we have a more normalized development? Our view is that we will have on midterm good markets. So everything is about inflation. So you have to look after your real positioning in your accounts. So we think on a midterm you will be a winner when you are with equities, but we could see also some periods when we have a broadening or a longer broadening, which we already saw since autumn last year.
Yeah.
So maybe I can just talk about US equity markets. For full disclosure, I'm a portfolio manager for US equity large cap, and my benchmark is S&P. So I'm going to have a home-based bias. I would say I'm still very constructive on US equity markets. I know in the past 5 years, the annualized returns 15%. The past 10 years, the annualized return of US equity markets is 15%. And we just had 3 back-to-back strong years. But to Thomas' point, I do think this is the year the US equity market will broaden out a little bit. So on surface, the biggest pushback I'm getting from investors today is the market valuation, right? It's trading at 22 times forward PE ratio. But when you peel back the onion, you know the Magnificent Seven still grow earnings north of 20%. So you got 20% plus growth rate from a Mag 7. And then also they continue to have technology leadership, continue to have a great balance sheet. So that portion, you could argue, deserve a higher PE ratio. But more importantly, this 493 bucket, the forgotten 493 stocks, that bucket this year will deliver faster and bigger EPS contribution to U.S. equity market, to S&P 500. This is the first time in 4 years the 493 companies will contribute more to earnings growth. And we expect that bucket to deliver double-digit EPS growth this year. The biggest, and by the way, this bucket is also treating a cheaper PE ratio. It's treating a 16.7 or 16.5 times PE ratio. So it's cheaper. It's going to grow faster this year. And the biggest step up when you talk about our portfolio allocation within the US equities, we're actually quite constructive on the industrial space because our analysts expect industrial sector to grow from almost a zero EPS growth to double digit, to 13% EPS growth. So that's incrementally faster growth. And when you, so last week I was talking to I went to an industrial conference and I talked to 20 CEOs and CFOs. And the key takeaway is pretty constructive. We all saw the PMI data, the purchasing manager data in January already turned about 50. That means we already start seeing green shoots on the ground. This is why I want to see the companies. And I got some confirmation. Obviously, half of the industrial sectors continue to be strong, right? It's a tale of two worlds. Whoever has exposure to AI infrastructure, power generation, aerospace and defense, and even pockets of mining companies continue to do super well. They continue to see faster growth. And I guess the only constraint they complain about is skilled laborers, right? They don't have enough skilled laborers, and that's the constraint, right? Supply chain constraint is that capped their growth. But another half, the pure cyclical part of the economy, some of the companies are seeing green shoots. Think about transportation, trucking, railroads. They're seeing improvement. So that's the area we see a lot of opportunities. Incrementally, that's where you want to allocate some dollars to.
You mentioned the AI infrastructure built out. At the same time, we see these big bond issues to finance that, and people getting a bit nervous around these very large bond issues by different companies. There was also the negative effect on, for example, Oracle that was punished by the market. What would you, how does that fit into the picture, and how do you see that as a risk? Or
I'm not a bond expert. I would defer to my other panelists.
I mean, rather, not how big it is, but rather the dynamics that
spending,
before
right?
I would finance it from operational cash flow, and now I issue bonds.
That's why you have to be a little bit more selective within the U.S. equity markets. You don't want to buy the super asset-heavy companies that borrow money to spend money. And I actually had a good fortune. I lived through the dot-com bubble. And when you compare and contrast, a lot of people talk about the AI bubble, right? So when you compare and contrast this time with AI, massive AI spending to the dot-com bubble last time, 95% of the fiber they lay on the ground stayed dark. This time, we're still having capacity constraint. When you listen to the conference calls of Microsoft, when you listen to conference calls of Google, the Alphabet, they're all complaining about they don't have enough supply. So it's the opposite situation. So that's point number one. Point number two is a lot of those spending are supported by healthy balance sheets. Yeah. So the Mag 7, you just saw the Big Four announce earnings past couple weeks, right? When you put Meta, Microsoft, Google, and Amazon together, $650 billion capital spending, all supported by healthy balance sheets. So we don't see, eventually it will be a bubble, pockets of pockets, some stocks you want to avoid. But I think at this point, we're still in the early phase of a spending level, and I don't, and yes, I'm not a bond investor, so you got to be selective as an equity investor, and I'm curious how you, as asset allocators, how you allocate.
Yeah.
capital.
I mean, how do you?
Maybe just to add one thing what Thomas and you said with this Max 7, and I think the broadening of the market is not possible with the Max 7 diving. And so we would have to have both the Max 7 doing well and the others doing even better. And I think that's the broadening case that we are also playing in our portfolio. And to come to your question with the credit, the high yield credit, it might not be the best idea, but we did not invest in last year because of the credit spreads are so low, and we decided to instead invest more in equities. So if you have the credit spreads at this level, the asymmetry is this big that it's actually an equity risk, and then we prefer the equity risk right away because the return expectation is there much better. And I think you have, and that's the point that Thomas also brought, we are not passive investors, and I think we are entering a better phase where we have to be selective, and we can select. And as I read today that 57% of active managers are beating their benchmarks in this year, I think we are entering a better phase for active management as well, and that would be a second layer of risk management and also performance driver.
Yeah. Thomas, maybe you want to also comment on the AI build out and the other points that were mentioned.
I think an interesting question if we also refer to the dot-com bubble. So we had a lot of telecom companies at that time. They invested like hell, and they were shut down almost immediately. So I think the interesting thing to watch is now how do the companies like Meta and so on, they are doing massive investments now, which they haven't done in the past. They were relying on the infrastructure from the telecom companies, more or less, because the network was running. So now they have to invest more in infrastructure, like a car maker investing in fabrics. So I think that's an interesting view from my side to watch. Maybe also a question for you. Are the managers of this company really able to act properly in this new environment when they have to do this mega investments from zero to hero and over the next 2, 3 or I don't know how much years, and really to cope with the problem, not to have extra cash on the balance sheet. And now they have to also communicate to bondholders. So maybe a question also for you.
Yeah, I'm more than happy if you want to stay on this topic. I know this is a tariffs session. It's not an AI session, but I'm more than happy to share my view here. But I do think you can see year to date, Magnificent 7 as a group is down 5%. Market's up 1%. And on surface, US equity market is doing fine. It's up 1%. But beneath the surface, there's a massive rotation going on here, right? Not only Max 7 underperformed, but you also saw defensive portion of the market went up a lot. So the sentiment is actually quite defensive. Consumer staple names went up a lot. Financials down. It's the worst performing subsectors, financials. But also, you have seen some of the industrial sectors, which I talked about earlier. They're doing really well because you see the incremental growth, faster recovery. But also, I like some of the pockets of the consumer names is quite interesting too. One of the names I just reported earnings, so Home Depot and Lowe's, when you look at housing in the US, has been below normal for 3-4 years now, and that's that they've been under earning. So we do see potential improvement from consumer part of the economy. But in terms of Magnificent 7, I do think investors' sentiment has changed from, yes, I still actually like Meta because it's very, very cheap from a PE ratio perspective. By the way, Microsoft is trading at 18 times PE ratio. Amazon is trading at half of the PE multiple of Walmart. Walmart is trading at 40 times, Amazon trading at 19 times. So investors are actually quite cautious on these companies, a lot of those bearish sentiments, because investors typically don't want to own companies that are going through a massive spending cycle. So you want to see clear return on capital. We will see, I think it's proof in the pudding, you want to see those companies start to deliver either top line growth or reach those return on capital spending, or the sequential capital spending will come down from here.
I mean, that's maybe still a few years down the road to see whether all these investments pay off. Let's now move to the tariff discussion. I mean, if you look at markets, it went down like crazy. The rhetorics, they're still there. There is market reactions. And I mean, the question goes first to Thomas and Daniel. How have you been repositioning your portfolio since Trump took office? And maybe also, this market has outperformed for so many years, and the allocation, at least if I go by index levels, they're quite high. Has there been a shift also in how we think about global equity or also bond allocations?
Yeah, not in the first reaction in April. There we saw this overreaction. I can remember it was on Monday. Monday we discussed about reducing risk in our portfolios, and I was strictly against that, because I thought it was, the thing, the tariff is one thing, but I think Trump is focusing on the economical reasoning, and if there isn't an economical reasoning, then he will come back and push back with this tariff. So we're not buying this bluff. Maybe it was bluff in the first case, and thinking that the tariffs will go down from there. But what has changed is that this U.S. exceptionalism is going to have maybe going to an end. And as we discussed, I think that there are other regions that are well positioned also for in terms of return perspectives. So we tried to shift away from U.S. not the. We are not selling America, but buying less America. I think that's the point. But and we're buying more emerging markets, more Europe, more Switzerland, but less America.
And you do that on the equity and bond side, or
on the bond side, we are Swiss focused or Euro focused, and we have a global approach, but everything hedged in Swiss francs. So we have U.S. Treasuries in it, and we are discussing to reduce them. But yeah, mainly on the equity side and the risk from the US dollar, and we like more the emerging markets or the European markets. But that does not mean that we don't have American assets. We just buy less.
Thomas?
I'd like to add, what you should watch or have a look on is, I think, the currency composition. So I think a lot of MSCI World investors from Europe, they got a big hit from the currency side. So all markets were double-digit up last year, and the MSCI World in euro terms was plus 3%. European equities were up 25, and in, not 25, 15, and in US terms 25. So I think where you have to have an eye on is currency, and the second thing is on the bond side, we still find some pockets, also then hedged back to euro or Swiss francs, depending on the strategy. You still find some pockets, but we would leave our hands off from government bonds and long duration assets currently. Yeah.
So just from my perspective, as you all know, last Friday, U.S. Supreme Court struck down the IEEPA tariffs. The whole sets of tariffs deemed illegal. So as a result, Trump administration quickly reimposed 15%. That's the Plan B. The 15% tariffs that's based on Section 122. And I don't really want to explain what it is, but that 15% can only last 150 days. And beyond that, we'll have to get congressional approval. And the market's reaction is pretty muted. The market didn't really react that much because we actually expect this to happen. But at the end of the day, I do think it's a positive news, more constructive news, because at least at this point, no more blank checks. You're not going to wake up in the morning and see and he posts a blog and then put 35% on you, 50% on another country. So at least at this point, I think it will be more constrained going forward. It will be less volatility from tariffs perspective. And I think, to me, that's potentially a little bit more old news from an investor's perspective. I think last year and continue to be this year, the biggest driver still were at the top. We try to avoid this topic of AI, but we can't avoid it, right? So it is still, at the end of the day, market direction. The next leg will be driven by earnings growth, will be driven by not only AI infrastructure build out, but also, the biggest topic these days is the AI disruption, who are, the winners and losers on that. So in terms of portfolio, I would say just from a tariffs perspective, last year, we all learned, do not overreact to political headlines, right? Whenever, if you're panic about tariff, you go to one side of the boat. Usually it's the wrong thing to do. And one of the most successful trades last year was the tackle trade, right? Trump always chickens out. And so same thing, if we saw the administration pass the Genius Act on crypto, a lot of people follow the momentum trade and went into crypto stocks and then crypto industry. And also that was wrong. So at the end of the day, as fundamental investors, follow the fundamentals. We're looking for companies that can navigate a different environment, right? And they have pricing power. They can carefully pass through some of the costs. They can improve productivity. They can adopt AI and then continue to cut cost expense, have a margin expansion. So those are the things we're doing from an active manager's perspective.
Yeah. How do you see this play out for the other regions that you mentioned that you're overweighting in your portfolio, Daniel, and also for Thomas?
You mean the tariffs, or?
Yeah, the tariffs, but also the AI adoption, because there's also a bit kind of two camps. You have China and you have the US, right?
Yeah, and they are on a race to the top, or to this supermodel. I think in the first place it will be for this year. I don't do these scenarios for many years, so in the futures. But for this year, we see that productivity is rising, and there the US has a clear advantage, I would say, over Europe. Maybe in Europe, Switzerland is very good position to adopt AI, and maybe China. But China is, from an investor perspective, a little more tricky. But we have this investment open with China Tech. We see it's even less expensive than the US, and it has the same earnings drivers. But that's what I meant. That the US, you cannot sell America because the US is that strong, and the companies within the US are that strong. And as you also said, they are owning the technology, they have the energy power, they have the balance sheet power, they have the earnings, and we also see that this goes on. But the others will catch up, and in this catch up, we think that emerging markets can do exceptionally well, because they are maybe the AI phase is going from the infrastructure to the user phase, and maybe broadening out some. In a way, and so you need materials, you need industries, and so on.
Good. Thomas, you get to have the final statement on the panel, and then we will be open for questions.
Oh, my final statement would be, keep on holding to risk markets. It can be a little bit bumpy in certain times. I think it will be interesting how AI will work out for different sectors. especially we in the portfolio. Just to give you an example, we have a small allocation to biotech. So biotech was one of the most hated sub-industries in global indices, or especially in the US. But if you think about AI, that gives a lot of productivity boosts to implement or get new treatments, new medicines to the market. And since June last year, this part of the market is doing quite well. So keep an eye on AI really adopters and practitioners, and not so much on how many chips NVIDIA will be selling. Their books are full, I think, for many years in forward. Maybe some information from your side.
We'll find out more tonight. Well, actually, it's probably recording, so yes.
So I would hold on to risk markets, and but on the other side, be flexible if really the world turns around. We think that the wake-up call was sent from the US out to the world, and it takes some time that it is heard in every reasoning country. Yeah.
Maybe in the beginning you also have a bit of peer group risk if you want to underweight the US because no one else is doing it. Good. We will be open for questions now. Are there any questions? Yes.
Thanks. You drew out a sort of Goldilocks scenario, with your headwinds, tailwinds, all of that. But what's the worst case? Because you've said, like, the remaining companies, not the tech companies, would continue to perform well. It all sounds like Goldilocks, but we know that's not going to be the case. So there'll be lots of volatility. But what is your worst case scenario, and how are you positioned for it?
The worst case scenario. I always get this question. I'm a glass half full person, so I just painted a more constructive scenario, right, without the trifecta support. So what are the biggest risks out there? The first risk is always policy mistakes, right? We were going to have a new Fed chair, Kevin Walsh, and for whatever reason, the bond market always wants to test the Fed chair. So we might see a little bit on the credit market side. You also saw some occasion, like the cockroaches in the private credit space. I don't think it's systemic, but you're going to hear scares like that. So the bond market may test the new Fed chair. You might see private credit, some issues there, but I don't think it's systemic. And then obviously, we just spent some time talked about the AI infrastructure spending is a big dollar amount, right? $600 billion. And if you're bearish, you might think that's a huge dollar amount. Are you going to get a return on that? But if you're bullish, you may say, hey, one person's spending is another person's revenue. Who are the beneficiaries of that, right? So that's another way we want to think about. So there are always both sides of the coin. We know there's a big blog post a couple of days ago because the investors are super nervous. And this whole AI distraction debate is everywhere. And there's a very small research firm put out a big, I don't know how to describe that piece of research, but it's one-sided. It's a prediction on 2028. I do think they're missing some important points. And you mentioned, Daniel, you talked about productivity. With all those investment, we're going to see productivity boost. And what that research report is missing is all the productivity boost we might be getting. So I don't know whether or not I answer your question, but I do think there are always risks somewhere, right? You want to manage that risk, so there are always unknown unknowns.
Yeah. So using duration to manage that risk, or are you just staying, long and then opportunistic, or?
So if you're as an allocator, I'll defer that to Daniel and Thomas. As a U.S. equity investor, I'm a fully invested at all times, but I do have more tools in my toolbox than other active managers. So one of the products I've been managing for 20 years is long 130 and short 30 strategy. So I can go long, I can go short. For example, some of the stocks are really interesting shorts. And when you see capital spending is so high in the tech space, there's a memory shortage. Memory prices went up a lot. So whoever uses a memory as an input might be facing some pressures on the margin side. So you want to avoid those companies by maybe shorting those companies. And then also in the utility space, we all heard, in order to build all the AI data centers, we need to build more power generation. But not every utility company can build data centers. And there's an affordability issue. Trump talked about this yesterday at the State of Union. He doesn't want people to increase their utility bills. So some utility companies are not well positioned to benefit from that. So they're going to be winners or losers. So if you can go long, go short, you can capture that mispricings intra-sector.
Okay.
Thank you for your question.
Yeah.
About OpenAI and Anthropic. So OpenAI, I think it's expected that they would do an IPO this year. How do you view that massive valuation based on little revenues? Can they grow into this crazy valuation?
Yeah. So
given that there is competition, right?
Yeah, so I can't comment on OpenAI because I haven't seen data points there yet, but there's a rumor OpenAI, Anthropic, SpaceX, there are a lot of companies potentially will go IPO. So that's why you have seen a lot of blog posts from Anthropic, where a lot of price releases from Anthropic, because they're really releasing a lot of new products and plugins. And whenever you see an announcement, a group of stocks go down, that has been the experience over the past several weeks. And so I can't comment on the valuation because we have to see the data disclosure. Next week, there's going to be a big tech conference. Many of the companies will be speaking there, so we'll get more data point. And I will say one thing. I know there is a big debate on AI disruption. There's going to be a massive unemployment rate, and the robot's going to be replacing everybody here in the audience, and including people here on the stage. So I would say disruption, technology disruption, is a feature, is not a bug. The reason I say that is technology innovation is, and we lived through that over the past 40 years, right? From mainframe to PC to mobile to cloud computing. Every time we have technology innovation, you're going to create new winners and losers. Recall when Amazon started e-commerce, and then every dollar incremental in the retail space, 70 cents went to Amazon. During that period of time, you want to short or innovate every single physical retailers out there, right? Because Amazon is going to kill every single retailer out there. Walmart it just briefly passed $1 trillion market cap. It's a survivor. So there are going to be winners and losers. So Walmart survived, Costco survived, a lot of off-price retailers in the US survived. So, but a lot of companies disappeared. And you can go long, go short. One of the strategy I manage, we long TJ Maxx and short Bed Bath & Beyond. It went bankrupt. So same thing in the software space. I know software as a sector went down 25% year to date. They are going to be, and by the way, the selling has been indiscriminate, right? Everything went down 30% in the SaaS space. Everything went down 30, 40%. They're going to be winners and losers.
We are at the end of our panel. If there are more questions, you can take them up with the experts on the panel. Thank you for being with us and sharing your insights.
Thank you.
And thank you to the audience for listening to us.
Finally, the mandatory risk warning. The content of this episode is for general information only and is not a recommendation to buy or sell any financial products. All information is supplied without guarantee, and this is not an investment advisory. New episodes are released every Tuesday and Thursday.